I'm sure you've heard here and then that the financial crisis is over, or at least that the worst time of the crisis has already ended. However, my own personal thesis would be quite different. I would say instead, the financial crisis isn't over, it hasn't really begun yet. In order to talk about this very topic, I've rented a loft in Berlin during last December to meet up there with financial analyst Nomi Prins. She is best equipped to discuss the issue, as she was in the past a senior executive on Wall Street. Moreover, she is the author of inter alia this book, All the President's Bankers, The Hidden Alliances That Drive American Power. And by the way, I am now here at the loft that I was talking about. So now I am here in my rented loft in Berlin with Nomi Prins. Thank you for coming.
Thank you very much.
The reason why I wanted to talk with you here is I think the financial crisis isn't over yet. It hasn't really begun. This is the truth. Now, if this would be true, for example, that the underlying problems of the financial crisis of 2008 were not solved, isn't it then reasonable that we will end up with a real crash?
Yes, absolutely, because if we even look at why the problems that led to 2008 happened, it was because problems in the United States financial structure in the beginning of the 2000s had not been solved. We had deregulation of the financial industry in 1999, which allowed banks to consolidate deposits and loans with more speculative betting activities. And after that, about 2 years later, we had a kind of recession. We had a lot of scandals in our energy and telecom and banking sector. From that, we had rates lowered substantially in 2000, into 2002 and 2003, from which banks turned and decided to find something else from which they could make a lot of money. And that something else was subprime mortgages. It could have been any kind of debt. It turned out to be subprime mortgages. And those are packaged, as we know from the financial crisis stories, and resold and resold and resold throughout the world. And money was lent out by the same institutions that were buying and repackaging and selling them to the buyers, and that created more leverage and more debt in the system. And against that, derivatives were constructed and more complex securities were constructed and so forth. But all of that does tie back to a negative deregulation that happened in the financial industry, and no fixing to that when scandals emerged in 2001 and 2002. So then we get to 2007, 2008, and all of this falls apart again. And now we're in the end of 2016, and what fell apart in 2008, the crash that brought markets down, that brought financial institutions to require zero interest rates and negative interest rates and artificial liquidity from central banks. We are now 8 years into that period, and none of that has changed. They still require that artificial subsidy, that artificial stimulation. Markets are higher now because they've been able to take that money and use it for speculating and use it to invest in those markets. But there's been no solution to fixing what was the problem with the core of those banks. And what was at the core of those banks was that they have the ability to maintain the deposits and loans of individuals, and also to leverage and speculate and get involved in complex practices that are difficult to regulate and that ultimately cause havoc when they fall apart. That is still in play. What's different now and why it's worse, and why we're only sort of in the first phase of what's a bigger financial crisis, is because we've had these 8 years of buildup from the central bank's perspective, coming in and subsidizing the system with cheap money, with what I call artisanal money, because it's just manufactured, it's just sort of printed and given in a way to grease the wheels of these institutions, rather than to separate them, to break them up, to regulate them, and to reduce the risk that they can cause to the rest of the economy. So basically now, if we fall into a crisis, we're falling from this height where all of this extra debt and all of this extra capital in the form of cheap money from central banks has been pushed into the system, in addition to all the problems that related to the first part of the financial crisis. So that's why we're going to fall from a higher height. When we do that is a question, but that we will do that is definite.
Do we also have a huge problem at hand because the crisis was caused by big banks in the US, and those big banks, the very same banks, are the beneficiaries of the crisis?
Well, exactly. What happened was those were the same big banks that ultimately are the recipients. They're also the same big banks that pushed the deregulation in 1999 when the Glass-Steagall Act from 1933, which had separated their functions, was repealed effectively in 1999, which allowed them to consolidate their size and their complexity and their risk in one house, in one institution. Those were the same banks that were at the core of the financial crisis. Those are the same banks, like the big six banks, for example, in the United States, which are JP Morgan Chase, Bank of America, Citigroup, Wells Fargo, Goldman Sachs, and Morgan Stanley. They're still the banks that since the crisis have become about 43% bigger in terms of the amount of deposits that they hold, almost double in terms of the amounts of assets that they hold relative to their size before the crisis. And still maintain a 95 to 97% of all the trading assets that are traded in the banking sector, in the U.S. banking sector, as well as of the derivatives that are traded from the respect of the banking sector. So the bigger banks have merely become bigger since the crisis.
Mm-hmm. And is it also a problem that you have a central bank in the United States that was created by bankers for bankers? And is it also a problem that you mentioned, for example, JP Morgan Chase? I think JP Morgan Chase is the biggest part of the Federal Reserve Bank of New York. It is not just a member, it is also an owner of this bank. Is this a problem?
Well, yeah, I mean, all the banks have a percentage, have a membership within the Federal Reserve. So the idea of the Federal Reserve is that it's technically a institution that's not a government institution, and it's not a private institution, it's somewhere in the middle. But the reality is it's constructed from the standpoint of shares that are owned by and proportionally allocated to the banks that effectively get help from the Federal Reserve. So for example, the biggest banks have a higher share, a higher percentage of the membership of the Federal Reserve than the smaller banks. So when there's a problem, they have a bigger call on that. And actually, until like the 1940s, there used to be reports that came out on a regular basis from one of the 12 Federal Reserve banks that talked about, that actually just reported on the percentage that each bank held at the Federal Reserve, or of the Federal Reserve. And now those reports just don't come out. But you know, you can do the math. It really is based on, it's based on an asset size, and so you can sort of know that the bigger banks hold more. And they also were the ones that, when the emergency was happening, were on the phone with the Fed and on the phone with the Treasury Department, and have connections with the executive branch of the United States up through the president that effectively can say, look, we're going to have an emergency. We need funding. We need cash. We need the availability of liquidity so we can continue to function. Because if we don't continue to function, and we are holding all of these deposits from many citizens in the country, that could be a bigger crisis if you don't help us and if you do help us. And that was part of what led up to these policies. But that happened in 2008. We are now at the end of 2016, and those policies are still in place, which means, well, either the banks are very, very greedy, or which you can say, or they continue to require no-cost money because they don't have the ability to function as financial institutions without that external help, or both. And yeah, I think it's both.
Yeah. And what are now the problems that the Federal Reserve faces with the debt and interest rates? Can they just hike interest like they wanted to in the past?
Well, the problem is, and they tried to hike interest rates for the only time within the last 8 years in December of 2015. And all they did, after many conversations over the years and many guesses from the standpoint of the financial industry and the media and so forth as to when they would raise rates, and little bits of conversation coming from the FOMC, the Federal Open Market Committee, after their meetings to say what they might or might not do relative to how the economy was doing. That had happened for all these years, and all they did was raise rates by 25 basis points. So they took the lowest possible increment after over 7 years that they could possibly use to raise rates, and that's what they did. But the result of that, going into January and February of 2016, was a substantial, not so much a crash, but certainly a substantial melting of markets throughout the world. And the reason for that was that, first of all, many central banks throughout the world have been following at the Fed's direction, and in order to sort of coordinate with the Fed this idea of zero interest rate policy or cheap money to their own big banks, because that was part of the global coordination of this policy, which has never been done really before. This is sort of an unprecedented multi-year coordinated effort of the major central banks. But when the markets started coming down, the only thing these other central banks could do, because the Fed had just made its move, which was to raise rates, was to come in and lower their rates, and that's what wound up happening. So the first central bank to lower its rates from 0 to negative was the Bank of Japan, and then the European Central Bank, the ECB, followed shortly thereafter. And the idea of that was to compensate. Well, at first everybody was scared that the markets were falling and that this somehow meant liquidity, which had now been thrown through the banks into the markets or thrown through their clients, which whether they're hedge funds or private equity funds or whatever they might have been, into the markets. All of a sudden, there was a concern that it would be coming out if there was an expectation that money would cost more. So the idea of throwing all this money wherever and pumping up the markets, once that costs more, then all of a sudden there's a lot of concern and fear, which is what happened. And that's why other central banks, which had been coordinating up through that period with the Fed, came in to reduce their rates. So ultimately you basically had a global, in terms of major central banks, zero cost of money, 0% interest rates, again, even though the Fed was a little bit higher, and the ECB and the Bank of Japan was a little bit lower in terms of negative rates. So that's something that can happen again this year. Like, we're a year later, it's December, there's been a lot of talk about how the Fed's going to raise rates. Like, finally, that the US economy is strong enough, finally all the things they've been looking at are in place, which is sort of what they said exactly last year this time, and so now they can raise rates again. This time, the market's even higher than it was before they raised rates last December. But a lot of that is because of the sort of rally on the back of Trump being elected, and this idea that somehow he's going to spur growth, and all the sort of theories around what that could mean, whether they're true or not. A lot of times the market trades on theory and on speculation, not necessarily on actuality. And so the market's even higher now in terms of the stock market than it was before they raised rates last time. So that gives them more comfort to be able to possibly raise rates this time. However, if they do, they have two options: a 25 basis point hike or a 50 basis point hike. Last year they opted for 25. There's a possibility they do that again. If they happen to opt for 50, it's going to create a lot of chaos and equilibrium throughout the world, because now there's going to be 50 basis points that other central banks would technically have to make up for if there's an adverse reaction in either their financial institutions or in their markets. Yeah. And that's harder when you're starting at negative than it even was when you were starting at 0, which was what happened at the beginning of last year. So I think if they do that, it's going to cause a similar chaos to last year, which is going to spur the major central banks to come up with a quick solution again, or a solution within a 1 to 2 month period again. But it will be only expanding what they did last year, which is either reducing rates further, making them even more negative, or incorporating more quantitative easing, different kinds of quantitative easing than they did last year. But it would still expand this entire monetary policy, which has been designed over the last 8 years to support the financial system and a speculative type of investing in markets, as opposed to sort of foundational economic growth or infrastructure development, or sort of long-term sustainable growth.
Now, you have already talked about other central banks than the Federal Reserve, which is featured in this book big time. Mm-hmm. In your new book, which you are now researching, mm-hmm. I think the other international banks will
yes.
be part.
Yes.
Please tell us.
So that book, All the President's Bankers, what I did was take a look at the financial crisis and these big 6 banks I was talking about before, and notice that predominantly those same big banks were just new concocted amalgamations of the 6 banks that had been central to the crash in 1929, which had led to the Great Depression in the United States, which then spawned the Great Depression throughout the world. And so I could, and did in All the President's Bankers, connect the dots between the individuals and the institutions that represented those banks and the presidents throughout the last century and in the beginning of this century, and the relationships between all of those men, and how that pushed forward whatever the American domestic or foreign policy agenda was. And so looking at that per president, per set of bankers, and what you can see is that the bankers stick around a lot longer than any individual president. And so the presence and the sort of needs of the financial community are very much influenced and influential in Washington throughout multiple administrations, sometimes the same individual bankers. And so what I did since the crisis and predominantly starting to research in the last couple of years is how there's been this new actor to the stage here. In looking at American history, that the Federal Reserve was very key in terms of the development of having a central bank in the United States that could be that backdrop in case there was an additional financial crisis in the United States. That's how the Federal Reserve was created. In 1913. It was created in the wake of a financial crisis that happened in the United States in 1907.
The lender of last resort.
It became not just the lender of last resort, and also just the security blanket. Because knowing it was the lender of last resort, also know that it was somewhere where money could be created and could be taken in the case of a lack of funding, a lack of liquidity in the financial system, and that is how it was constructed. That's not how it was sold to the American public. It was sold as a central bank that would be there specifically for the smaller banks and to get money out of the concentrated Wall Street, the bigger banks, and into the middle of the country for helping farmers and into the end of the country for helping new people settling there. But that's not what wound up happening. What wound up happening is it continued and was created to be an institution that concentrated first and foremost on the larger Wall Street and New York-centric banks for the most part. But in the wake of the crisis, the Federal Reserve had a different role. And that role was to organize and coordinate its monetary policy throughout the world. And so it began in the wake of the financial crisis in the United States, which was to reduce rates to zero and to adopt a massive quantitative easing or buying of additional debt securities into the books of the Federal Reserve. So now it was not just simply lending to the financial institutions, it was lending at zero, effectively making money in all sorts of other ways available to the biggest private banks. But it was also buying debt securities, so it was effectively making money to the government as well, but going through the Federal Reserve, but all in the guise of helping to preserve the financial system as it was and to give it the liquidity it needed for the big banks to continue being big. It exported that policy throughout the world. So not only were there zero interest rates in the United States, and quantitative easing or buying of debt securities from a standpoint of U.S. Federal Reserve monetary policy, but it became something that was coordinated with ultimately the Bank of Japan, the European Central Bank, the Swiss Central Bank, the Bank of England has rates now at almost zero, but effectively it became a sort of globally exported monetary policy for what were sort of U.S. allied countries really since post-World War II. I mean, that's basically what happened, and that's what we're living in today. And so in a lot of these countries, there are very weak major banks. For example, Deutsche Bank in Germany, which is to a large extent subsidized by zero interest rate coming from policy and quantitative easing policy coming from the European Central Bank. To other types of banks, to the U.S. banks still being subsidized, to banks in Japan being subsidized, to even to an extent, but differently, banks in China being subsidized by the People's Bank of China. But that was a central bank, big as though it is, that openly criticized this policy of zero interest rates throughout the years that the Fed has adopted it, but still have rates pretty low relative to what they would have been before the crisis. So what I've been doing for the next book is seeing how that's really recreated the relationships between governments and economies and people on the ground in terms of what they would have expected or wanted from their governments and what they are feeling from the standpoint of their own economic stability or their own economic welfare. And what people are noticing throughout the world is whether they understand or know that there's a central bank operating in their country, because most people don't. It's like not what you think about every day. But whether they know it or not, they understand that something's kind of gone wrong and that they're not benefiting most people to the extent that the stock market is benefiting, to the extent that the bond markets are benefiting, because central banks are either buying bonds or making it possible to issue bonds at zero or very cheap percentages, so there's more debt in the world, but it's not being used to benefit people. It's not necessarily being used to increase their stability.
Yeah.
And as a result of that, there have been a lot of things that have happened throughout the years, everything from the Arab Spring to the crisis in Greece to the vote for Brexit to the vote for Donald Trump in the United States, that have really been manifestations of this policy, which has subsidized the private banking system at the expense of sort of a long-term structural focusing on the foundational economies of people throughout the world. And what people who can vote on matters that affect them, like changing their elected officials, are doing, is voting against whoever's in power who doesn't get it. And it's called different things. It's called voting against the establishment. It's called it's called being racist. It's called being xenophobic. I mean, there's a lot of things that it's called. But the reality is that there's a disconnect between what has been done at the central bank level and how it has affected most people.
Yeah.
And so I've been going around the world looking at that on the ground in terms of the major countries and major central banks, and just sort of looking at that trend around the world. And as it turns out, I've been doing that in 2016 as things have been happening around the world, and these decisions are being made on a voter basis that really started from a financial crisis that wasn't really taken care of in a proper way by central banks that have emerged as very powerful players in this whole drama.
Now, a specific question that I would have is, how did the policy undertaken by the Federal Reserve affected the policy undertaken by the Chinese Central Bank, the People's Bank of China?
Well, because ultimately, the larger countries are trading partners with each other, and to the extent that they are able to, as a central bank, technically, the responsibility is to make money available at a rate that doesn't create too much inflation, but that sort of keeps inflation within a particular band. So what's happened is, as this cheap money has been fabricated from the United States and throughout the central banks with which it's coordinated in those countries, and not in all countries, but in those countries, it's been done in an environment of very little inflation or artificial inflation. And this is actually another thing that's disconnected, where people actually do feel the cost of their living going up relative to their wages. But inflation, as it's measured at the top level, at the GDP level, at the central bank level, at the government level, is very flat, which is why this stuff continues, because it's very different for how government measures it versus how people actually feel it. But as a result of kind of that measurement, the People's Bank of China, and China hasn't sort of felt that level of inflation, and it's also had to compete on a currency basis with other currencies that are connected to central bank policies that are reducing their rates, which has an effect on their currencies. And in order to just be in the global market and be competitive, it's had to some extent to adopt and reduce its rates in a similar manner. I mean, China operates differently relative to their private banks in that there's a much tighter connection between the People's Bank of China and the government of China, and a much tighter connection between the banks in China and the government of China. And so a lot of subsidies to banks in general come kind of direct, and there's sort of a tight subsidy throughout the banking system there. And that's where China's different from the United States, where it's not necessarily that the money's coming from the government to subsidize the banks. It's just being made available from the Fed to subsidize the banks, which is just slightly different in terms of the private versus public system. But China's very openly critical of this entire scenario, really from the get-go. They're very openly critical, and increasingly so over the years, of the Federal Reserve's policy of keeping rates, of bringing rates to zero, and quantitative easing, and how that would create sort of artificial bubbles throughout the world, and that those would be difficult to sustain, and that creates additional risk in the world. So even though they brought their rates down to an extent, they haven't brought them down to zero or negative, and they haven't adopted the same sort of quantitative easing methodologies of the Bank of Japan or the ECB or the Federal Reserve, and they've continually been wary of just how infusing so much cheap money with so many kind of coordinated mechanisms can actually create more havoc later on than it's helping now.
You've mentioned infrastructure in the US that was not undertaken as a modernization program. In China, they have the new Silk Road, an infrastructure project in Eurasia, highways, fast trains, internet, and then also a maritime Silk Road with harbors and so on. And they are spending now the foreign exchange reserves that they have acquired, and they do not increase them anymore. Is this a smart move to create equity in your neighborhood with money that you receive? Basically, I would say, by selling the US plastic items. And now they are making stone.
Yeah, I mean, what they've done, and they've exported that idea of infrastructure building instead of merely speculating. So actually creating what becomes real property and real assets and real jobs in the meantime for real people. That's kind of what they've been funding. And they've done it, Chinese have done it with respect to, for example, Brazil and South America in general. Over the last years, they've funded and they've lended more through Chinese banks than U.S. banks have had. What U.S. banks tend to do is work with companies and securitize assets and try to extract profits, and it's sort of less of a long-term partnership and just more of a sort of extraction of whatever excess profit there can be at a short-term basis. But what the Chinese have been doing is trying to build relationships and funding relationships that also create infrastructure. And they've been doing it internally in China, they've been doing it throughout Asia, they've been doing it with some of the countries in South America, and that's been that philosophy of turning money into long-term stability. And in particular, they've been very active in not just the fast trains, which are just so much better in China and in Japan, for that matter, than in the United States, where we don't have them. Or if we ever, we only, I mean, there are some, but for the most part, there is no, for example, fast train that connects Los Angeles, where I live, to New York City. I mean, it just doesn't. And the highways are not what they were. And it's not something that's been funded by the government to any extent, which is one of the reasons why the economy is said to look good on the top level, because this money is going into markets and so forth on a speculative basis, but not to real people and in real jobs, which is why there's been such an economic anxiety on the ground in the States. So I think China's been just taking the opposite view of that, that how to grow and how to have an economic and political dominant position in the world is to be more methodical about their relationships with building and infrastructure in other countries and long-term initiatives rather than simply speculating.
China follows also another different approach relative to the West, and this is its gold buying. Not only China is buying gold big time, but also other members of the Shanghai Cooperation Organization. Is this of interest to you vis-a-vis the perspective that ownership of gold gives you a certain type of independence from the US dollar?
Right, so this also goes back to what the Federal Reserve did in the wake of the financial crisis and how China in particular viewed that policy, right? Because all of a sudden there's a crisis in the United States in the financial system. That crisis in itself didn't impact China in that the U.S. banks weren't selling toxic securities into China. China wasn't a part of loss on those particular securities, but ultimately, because we are all in a big global trading environment and ultimately a global economy, China did feel the loss at the economic level to an extent, and it wasn't able to really have any say in the monetary policy that was used relative to the U.S. dollar and relative to the U.S. banking system, which are connected. And so one of the things that China did from that perspective is seek to establish itself as more of a dominant reserve currency, because up until October of last year, China wasn't even in the special drawing rights basket of the IMF, which had been created in the wake of World War II, and in which the dollar is still the supreme currency because it is the currency of choice as a reserve currency, meaning that most central banks have in their reserve assets that can be denominated in dollars, and then that's basically what it means. And to that extent, the Federal Reserve, as the dominant central bank, has more control over global policy, and it exerted that control in the wake of the financial crisis to save its banking system and the banks with respect to the rest of the world. China was not able to really jurisdict any of that. And so what they did was try to find a way to get into the SDR and to sort of have their currency adopted into more of a global reserve type of basis. And so one thing was to get it in the SDR, where it popped in the middle in terms of proportional percentages of weights in the SDR. So now it's basically the US dollar is top, and then the euro, and then the Chinese yuan, and then the Japanese yen, and then the British pound. So it kind of popped in as a middle reserve currency. Those bottom three are about the same. China's a little bit higher than the other two, but it was a starting position. And that's one way to gain independence from the standpoint of the dollar, not just because it's in the basket of the IMF, but because of what that says politically and what that says from a forward-looking strategy. Now, gold's the other side of that in terms of trying to gain independence from a strategy that was detrimental not just to the US but the world, and over which China wants more control, not just to have global control of a currency, but also to be able to maintain more stability that it can influence. And so having gold is a way to get back to a kind of more independent equilibrium as well. So one element is your currency, which is what your central bank is basically holding or moving securities in, with which it has currency swaps with other central banks and is moving liquidity throughout the world. But the other is to have something else that can be used in the event of a crisis, in the event of a necessary element to create more stability.
Yeah.
A net of a currency that becomes gold, which used to be sort of the dominant peg, the dominant currency in the world until 1971, in which the Chinese have been not just buying, as have their larger trading partners, as China has been also developing more trading alliances outside of ones that have the U.S. involvement to be able to have that extra independence. But also in terms of buying gold or having its counterparties or its allied countries buy gold as well, it's a way to move that dependency on the dollar from that new trading bloc and that new diplomatic bloc into something that's potentially pegged to gold, or at least a percentage pegged to gold.
Yeah. I would like to read a quote from the IMF, and the IMF writes, "The gold bullion component of monetary gold is the only case of a financial asset with no counterpart, liability." Now this means if gold is the only financial case, that this does also exclude the SDR. However, China, for example, could call for an inclusion of gold into the SDR, and the situation changes then.
Oh, right. I mean, any inclusion, if there were to be of gold in the SDR, and the IMF, by coming out with that statement, is indicating that gold has less dependency or less volatility relative to counterparties, relative to other central banks and their either monetary policy or currency movement, where gold's more independent from that. So if they include gold in the SDR, that also creates less volatility of currencies relative to each other in the SDR, but also in respect to how they operate in the world, how central banks move their currencies back and forth, and how reserves are computed and held. So if gold becomes part of the SDR, it has more stability. And it also means that the countries that possess gold have the ability to have more of their own percentage of allocation in the SDR. So if China has more of a percentage gold relative to its current percentage, and say the US has relative to its current percentage, then altogether, if there's a gold component added, China has kind of more power relative to the dollar, relative to the US. And so that's one of the reasons it's both stockpiling gold. Its counterparties outside of the U.S. are also buying more gold, and it is pushing to have gold included, because that's just another way of being independent from not just the dollar, but dollar policy.
Yeah. So now we have December 2016. You have a new president-elect. His name is Donald J. Trump. What does China have to expect from presidency of Mr. Trump? For example, in his campaign, he was accusing the Chinese of currency manipulation.
Right, well, one thing I should say about that accusation is that it has been sort of a policy of individuals on both sides of the political spectrum, from both parties, to bash China as a currency manipulator. So under President Obama, his first Treasury Secretary, Tim Geithner, routinely talked about currency manipulation from China, as did the head of the Fed, Ben Bernanke, as did or is the current Treasury Secretary up to a point. He's not now current. He hasn't recently called him a currency manipulator, but he has certainly talked about watching them as a currency manipulator during his term as Treasury Secretary. So this was already going on. So all Donald Trump did, well, not all, but he basically maintained this idea of blaming China for any kind of trade issues or deficit issues that the United States is experiencing. If you sort of blame China for manipulating their currency, then there's less of a need to worry about the issues of equilibrium of trade with respect to products coming in and out of the United States. But he was very good at doing it, and that was one of the things that, not just the idea of currency devaluation or manipulation that he was good at, but also the idea that China is taking U.S. jobs, that China is basically, the trade agreements with China are detrimental to the U.S., and all sorts of other negatives on China, which is one of the things that he did very strongly run on in terms of his election platforms, in which he did also probably get a lot of votes on. This idea that if people are, gone back to before, dissatisfied with their economic condition, and there can be sort of scapegoats outside of the United States, outside of their condition, someone can come in and say he's going to take care of, whether that's trade with Mexico or whether that is trade with China, then that was something that held a lot of sway in terms of their votes. So if Trump gets in, I don't think he's going to necessarily do much more than call China names from the standpoint of trade. He's not necessarily going to, he's already not going to be part of the Trans-Pacific Partnership, which didn't include China. Mm-hmm. And China's already creating its own partnerships in the region, which don't include the U.S. So those two things were effectively in motion before Trump came in, and I don't see that necessarily changing. I see Trump continuing to go about potentially doing bilateral or just individual trade agreements with countries like Japan. Maybe he negotiates something with China, but China is going to, moreover, continue to create its own trade and political alliances outside of the U.S. And that's really going to happen throughout the Trump administration, I think. Or actually whoever would have been president, but certainly going to happen in this administration.
Now, if we would take a group photograph of those people that Mr. Trump picks as appointees or he considers to nominate in certain positions, what does this group photo tell us so far?
Trump likes rich people, like himself. His cabinet right now, if we just sort of take that photo where it stands as he's formulating it, has a net worth of something between a minimum of $12 or $13 billion and a maximum of $35 billion. So in terms of the just size of the wealth these people that he's choosing represents, it's at a minimum 4 times the amount of wealth that the Obama cabinet represented, which is higher than wealth of past cabinets. So in the States anyway, the cabinets have been getting richer, so the people with the more influence that are coming into appointed positions in the cabinets of various presidents tend to be very wealthy. Mm-hmm. John Kerry, our Secretary of State, is not exactly a pauper. But the people that Trump is bringing in are much more in the billionaire status than simply the multimillionaire status. So he's kind of like up the whole thing by many levels. And a lot of these individuals are coming from the private sector and haven't had any public sector experience at all anywhere. And so they're basically bringing an ideology and a mentality that isn't about helping the public. And it's not about what's best necessary for the population of the United States. It's what's possibly best for how they see the United States as this kind of business entity in the world, as opposed to a government where there's responsibility to individuals within the country, not simply to the individuals who are running the country, the ones in the cabinet or their associations. But by nature of the types of people he's choosing, it's very easy to assume that their allegiance will be to themselves and sort of their constituents, which remains at the very elite parts of the population, instead of sitting down every day and thinking about how people in sort of the middle of like Kansas or whatever are going to be able to pay their bills or whatever.
If Mr. Trump would run your country like one of his businesses, how would this look like?
Well, we have a historical kind of precedent to that. Back in the 20s, our president, one of our presidents, Calvin Coolidge, who was the president up through what led up to the crash of 1929 and ultimately the Great Depression, called the business of America was business. The business of America was a business, and so, but that mentality and the mentality of his Treasury Secretary, Andrew Mellon, who had been the Secretary of Treasury for Warren Harding, who was our president right after World War I, so the beginning of 1921, and also through Calvin Coolidge and also through Herbert Hoover, who was our Commerce Secretary under Harding, but became the president after Calvin Coolidge. So all of the presidents effectively in the 20s were people who wanted to run the country like a business. And they all shared a Treasury Secretary who was one of the richest people on the planet at the time. The result of that was a massive crash and a massive depression. So we've seen this. So again, if you look at history as an example and the fact that Trump and his cabinet are that situation in terms of their policies, in terms of some isolationism, in terms of wanting to deregulate the very same types of institutions that were deregulated back in the 1920s by a different crew, but the same sort of mentalities, we can pretty much assume that we're going to have similar results.
In your last answer, you mentioned two interesting terms, and these were crash and depression. We come now back to our first questions, and that would be that the crash is still lurking out there. It is still an event waiting to happen. And now, what do you do in order to prepare for things to come? Can you recommend something to our viewers?
Well, I think in any type of financial protection, right, you have to be as insulated from markets as you can be, but at the same time, because we have interest rates at zero, because people aren't getting money in terms of just putting it into the savings accounts at banks, they have been looking outside to be able to make ends meet and to be able to sort of have some element of the prosperity or appreciation that markets have had, and so there is an exposure. So how do you reduce that exposure so that you reduce your risk if there is a crash? It's really to reduce being a participant a little bit along the way. Maybe not fully at any one given moment because there is this idea of a rise versus not an interest rate payment on their savings account, but getting out of the markets, paying down debt and basically looking at how to be involved in just like hard assets, whether that's owning more of your house or whether that's owning or having less debt or whether that's owning gold is one element of the portfolio. It's not all there is, but basically the idea of having physical assets and ways to make ends meet in your life that don't involve having to speculate on the market and don't involve having to sort of be involved with the chaos that could ensue at the above level. And those are little things for different people. For example, in the United States, there are fees that these big banks require in order to just simply have a checking or savings account. And if you look at how much they are charging just a regular person who doesn't have a lot of money, because people who have less money tend to get charged more fees at any of these banks. They're charging, for example, $20 a month for someone just to have a checking account or a savings account. Well, if you only have $1,000 at any one time on average in that account, you're paying $240 a year for the luxury of not getting any interest. That's 24%. So one thing people should and can do is take a look at where their exposure to this system is also a high total cost relative to the money that they have in the system, and look for alternatives to reduce that. Not be involved in a bank that charges you that, negotiate those charges. I mean, those little things along the way help you shore up some of the leakage, some of the expenses are going out, so that if there is a crash, if there is a situation, you just have more of your cash either out of banks in assets or in ways you can actually use it.
Yeah. Thank you very much for coming to my rented loft.
Thank you.
And so Nomi Prins and I vanished into the nightlife of Berlin to have a joyful time, while we both knew that the real crisis is still lurking somewhere out there, or, to paraphrase Al Jolson's famous words, "You haven't seen anything yet, mama."